You are staring at two listings on a laptop at midnight. One says rent, $2,000 a month. The other says mortgage, $2,050 a month. And instantly, buying feels smarter. $50 more, but part of that payment comes back to you as equity. Renting looks like lighting money on fire. Buying looks like a machine that turns monthly bills into wealth. But the mortgage quote is not the cost of owning the house. It leaves out property taxes, insurance, repairs, closing costs, selling costs, and the money your down payment could have earned somewhere else. Then there is the surprise waiting at the exit, taxes when you sell. Before we can know who wins, we have to stop comparing rent to the wrong number. So I am not going to tell you renting is better, and I am not going to tell you buying is better. I am going to treat this like a case file. Same household, same city, same time period. Then we follow the money from the first check you write to the day you move out. By the end, you will know how to compare the true monthly cost, the cash trapped up front, the equity you build, the return you give up, the cost to sell, and the tax rule that can change the ending. Because rent is not automatically wasted money, and a mortgage payment is not automatically an investment. The real question is what each choice does to your net worth, your cash flow, and your options 5, 7, or 10 years from now. The first number we need to dissect is the one buyers love quoting most, the mortgage payment. Here is the trap. When someone says, my mortgage is $2,400, that is not the cost of owning the home. That is usually just the loan payment. And even inside that one payment, two very different things are happening. Part of it is principal. That reduces the loan balance. It becomes equity, assuming the home holds its value. The other part is interest. That is the price you pay the bank for using its money. Same check, completely different economics. On a 30-year mortgage, the early years are especially deceptive. A huge share of the payment can go to interest, not principal. So the buyer feels like they are building wealth every month, while the amortization schedule quietly says, not much yet. Good math separates the pieces. Principal is recoverable equity. Interest is an unrecoverable cost. Then you add the costs that are often missing from the quote: property taxes, homeowners insurance, private mortgage insurance, homeowners association dues, and repairs. Bad math takes the whole mortgage payment, compares it to rent, and calls the difference an investment. That is how a house starts looking cheaper than it is. Yes, mortgage interest and property taxes can have tax benefits, but only if you itemize, and only if itemizing beats the standard deduction. For many households, that deduction is smaller than the sales pitch suggests. And even after you separate the payment correctly, the biggest ownership costs are often the ones that arrive irregularly. A house does not send you the expensive bills on a schedule. It waits. The roof looks fine until a storm finds the weak spot. The water heater works every morning until the floor is wet. The heating and cooling system hums in the background until a technician says the word replacement. That is the part renters often transfer away. If the dishwasher dies in a rental, you usually call the landlord. If it dies in your house, the landlord is you. Same with the tree trimming, the gutter repair, the pest problem, the cracked tile, the fence leaning into the neighbor's yard. And the big ones do not care about your spreadsheet. A roof can erase years of monthly savings. A new heating and cooling system can wipe out the difference between owning and renting for a long time. A homeowner's insurance premium can jump after disasters hit the region. A property tax reassessment can raise the payment even when the mortgage did not change. A homeowners association can vote for a special assessment, and suddenly the affordable condo needs thousands of dollars in cash. These costs feel like exceptions because they are irregular. Psychologically, we treat them like bad luck. But over a long ownership period, they are not bad luck. They are part of the normal price of owning an aging physical asset exposed to weather, local taxes, insurance markets, and neighborhood rules. Renters have problems too. Rent can rise. The landlord can sell. You may have less control. But the budget is simpler. Fewer surprise bills. Fewer five-figure moments. But the cost of buying does not begin with repairs. It begins before you even get the keys. Before the first mortgage payment ever hits your bank account, buying has an entry fee, not just the down payment. There are closing costs, payments, inspection fees, appraisal fees, title charges, moving costs, prepaid property taxes, and homeowners insurance. Sometimes points, loan origination fees, or other charges that sound small until they sit together on one page. On a $400,000 home, a 20% down payment is $80,000. Closing costs might add another $8,000 to $20,000, depending on the loan, the state, and the deal. That is money required just to enter the game. Renting has upfront costs too. A security deposit, first month's rent, sometimes last month's rent, application fees, maybe a pet fee, annoying, but usually much smaller. The difference is not just size, it is recoverability. A security deposit may come back. A down payment becomes home equity, but it is now trapped inside the property unless you sell, refinance, or borrow against it. Closing costs are mostly gone the moment you sign. That means the buyer starts behind. The house has to appreciate or the loan has to be paid down just to overcome the cost of getting in. And if you sell too soon, you face the exit fee too. Agent commissions, transfer taxes, repairs, concessions, and moving again. This is why break even matters. Buying can win over time, but time is the machine that makes the math work. That timeline matters because the money locked inside the house has a shadow cost. That shadow cost is the investment you did not make. If you put $80,000 into a down payment, that money may build equity, but it also stops being available for everything else. It cannot sit in an index fund. It cannot buy short-term treasury bills. It cannot stay liquid for a job loss, a business idea, or a move across the country. This is the missing comparison. The real question is not, is my mortgage close to rent? The real question is, what happens to the money I did not spend? Say renting costs $2,500 a month, and owning the same kind of home costs $3,400 once you include the mortgage, taxes, insurance, maintenance, and repairs. That $900 gap matters. If the renter invested every month plus invests the down payment they never handed over, they are building wealth outside the house, quietly, automatically, without a water heater deciding to explode on a Tuesday. But flip the numbers and buying can win. If the mortgage is cheaper than rent, if the home appreciates, and if you stay long enough for the upfront cost to fade, ownership can become a powerful engine. The mistake is treating the house like it competes against nothing. It competes against every other use of your cash. But even if buying wins while you live there, the scoreboard can flip the day you sell. Then comes the exit fee. On Zillow, your house went from $400,000 to $500,000. That looks like a $100,000 win. But paper equity is not cash in your bank account. To get that money, you have to sell. And selling has a toll booth. There may be agent commissions or platform selling fees, transfer taxes, repairs the buyer demands after inspection, fresh paint, staging, landscaping, and photos to make the place look effortless. Then concessions, closing credits, moving costs, and the remaining mortgage payoff. So that $100,000 gain can shrink fast. Maybe you walk away with $70,000, maybe $60,000, maybe less if the roof, the air conditioner, or the buyer's lender decides to make the final week expensive. This is why time horizon matters. If you own for 15 years, appreciation and principal paydown have time to bury the buying and selling costs. If you own for 3 years, those costs are still sitting near the surface. Buying is not just a monthly payment decision. It is an entry price and an exit price. And after the exit costs, there is one more question. Is the gain yours to keep? And this is where one IRS rule can make two identical looking home sales have completely different outcomes. Here is the rule most people miss. If the home was your primary residence for at least 2 of the last 5 years, United States tax rules may let you exclude up to $250,000 of capital gain if you are single, or $500,000 if you are married filing jointly. That is enormous. A renter who invests and sells stock may owe capital gains tax on the profit. A homeowner who sells a qualifying primary residence may keep a huge slice of appreciation tax-free. That can change the entire rent versus buy math. But the word may is doing work. If you lived there for only 1 year, the rule may not protect you. If the gain is bigger than the limit, the excess can be taxable. If you moved out and turned the house into a rental, depreciation and non-qualified use can complicate the bill. And the tax benefits while you own loan are not automatic prizes either. Mortgage interest and property taxes only help if you itemize, and many households take the standard deduction. Property tax deductions also run into limits. So the villain in this story is not renting or buying. It is the shortcut people use to choose between them. The shortcut is pretending the answer lives in one line: rent versus mortgage. It does not. The real comparison is rent plus investing versus owning plus every cost that does not build equity: repairs, insurance, taxes, closing costs, selling costs, loss flexibility, the emergency fund you need when the roof fails on a Tuesday. That is why the same house can be brilliant for one person and a trap for another. Buying wins when time, taxes, cash reserves, and the local market line up. Renting wins when flexibility and invested savings beat forced ownership costs. The point is not to sound grown up, it is to stay resilient. Now we can finally answer the question from the beginning with a usable rule. So the answer is yes. A house can look cheaper on the monthly payment line and still lose after ownership costs, opportunity cost, selling fees, and taxes. The scorecard is simple: compare unrecoverable rent against unrecoverable ownership costs. Separate principal from interest, add entry costs and exit costs. Model the years you will actually stay. Then check whether the capital gains exclusion protects your sale. Buying wins only if it survives all of that. Your next step: build a 2-column spreadsheet. Rent and invest, buy and sell. Run it over your real time horizon. Comment your city, rent, target home price, and expected years there. Thanks for watching.